What's up? I'm Dan Fredenberg, and this is another chance encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house. It's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. Today I'm joined with Tim Dowling. How are you doing today, Tim?
Fantastic, Dan. Thanks for having to talk with me.
My pleasure. And did I get the vowel right? It is Dowling. It's not like Dowling or something
You
like that.
you nailed it, man. You nailed
Okay.
it.
Sweet,
Yeah.
sweet. So that's not the only piece of good news I have for you today, Tim. I don't know if you're aware of it or not, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, passive investors, buyers, sellers, all that kind of stuff. And you might ask yourself, why are you doing that? And the answer is, if you've ever heard of the off-market private deals you're not allowed to publicly discuss, sometimes they're called 506B deals, you should know that the SEC requires that you have documentation of your prior substantive relationship, or else they'll get ants in their pants and they might take away your business in the form of rescission, and that's bad. So I have people on here talking about their core competencies, their buy box, appetite for risk, all that kind of fun stuff. And the best thing for you is you get to learn how to more effectively communicate on the subject of a commercial real estate deal and know how my guest fits into them. But before we get too excited about real estate, Tim, do you want to introduce yourself a little bit to the audience?
You bet. I am a commercial real estate developer. It's a progression, over 20 years. Started off as a typical, your realtor, and moved my way and all the way found my stuff. And I'm currently building an apartment complex. We're in final round of permits in South Austin. And we're probably about 2 to 3 months away from getting that permit and start playing upward. I'm also, my passion project is I'm also doing a retail development in my own backyard in a little town called Buda, right on the edge of Austin. We're doing a 64,000 square foot retail development. And I'll throw out there, last night was exciting. We had, if I'm tired and I seem like I'm not all together there sometimes, we had city council meeting last night, and my phase two, which is, we're doing a community center. What I mean by that is we have all the retail components, but we're also adding pickleball, volleyball, an area for family and neighbors to go to and to be part of, because my little town of Buda is lacking in it, and the city is 100% behind it. So that's, in a nutshell, I'm a developer guy, but I'm trying to make cool stuff.
I love it. I love it. And it's always great to have people who are actually putting the shovels in the ground. It's a big difference from someone who's just doing a syndication or something like that. But the first segment that we always have in our show here, it's the 5 distinct motivations. And Tim, I don't know your level of technical acumen, but I gotta say, but wait. Check your eight. Could you do me a favor and try and look through the camera and down there in the user's device? There might be this big hideous subscribe button if they didn't hit it yet, and it's totally free. They should probably okay.
Right down there?
Yeah, exactly. That's exactly where it is, and it's a really good idea to hit that. But anyway, the 5 distinct motivations. I have now literally interviewed hundreds of commercial real estate players. We're pushing about 400 right now, and everybody has their own unique why that brought them to commercial real estate. And the reason why it's important to know what that is as a real estate person is because when the going gets tough, it gets really tempting to throw in the towel. And so if you know their motivation, then you can tap into that and you can have a little bit more assurance that they're going to follow it all the way through. And even though everybody's reason why is unique, I find they fit pretty neatly into these 5 categories. The first one of which is preservation of purchasing power. What on earth is that? Well, some people are completely work optional because they already have a portfolio of assets that pays their bills. Some people are earning far more than they are really realistically going to be spending, and so they're putting away a portion of their paycheck check all the time. And the main concern in that situation is to make sure that it doesn't dwindle away, that purchasing power. Now, when somebody has this as their main motivation for their acquisitions, what makes them a little bit special is they don't have to do deals for deal's sake. So they're only going to pull the trigger if it really, really works. One example would be if inflation is eating away from the purchasing power of your cash flow, you're going to be making a new acquisition that way. But more realistically, when I say these deep discounts, I'm talking about asset crashes. I'm talking about when things are really low priced. And of course, everybody should try to negotiate the deepest discount they possibly can. But the emphasis here is if you're in this situation, you're going to be more patient than somebody who needs to do it all the time. Now, full disclosure, I'm not at this part of my real estate journey yet. What describes me a little bit better is trading time directly for wealth. My background is in technology, specifically the CRM space. I started my own CRM agency as a full stack developer back in 2011. And so as I was pursuing higher wages, higher salary, higher income, I started working in 2014 for a group that was doing 10 single family transactions per month, 10 flips per month. And I started to go, hey, wait a second. It seems that the tax code is written where if you are getting compensated in the form of deployed capital, AKA equity, it's hugely advantageous compared to getting an enormous salary and then giving half of it away to the government in the form of tax. Now, I get that that's a little bit subtle for some people, but that is my main motivation. The more frequent motivation for a lot of people, especially youngsters, is they want to either hustle like crazy and fast track retirement, or they at least want the autonomy to be able to make their own schedule. Now, of course, one issue that comes up with people who tend to have this as their main motivation is they think it's everybody's motivation secretly, and they're just in different levels of hiding it. And I assure you, there are people out there where their retirement is not one of their motivations whatsoever. One example of which is the people who are fueled by ambition. They want to buy their entire hometown. They want that generational wealth. They want to make sure that their great-grandchildren never have to hold a day job. And that's why they're going to hustle into their 90s. Now, I get that some people vilify that sort of attitude, but the fact is, real estate requires maintenance. It requires somebody who's not asleep at the wheel. You need somebody who's motivated day in and day out to come into the office and make lives better through being an owner. And the other version of that sort of ambition, it's not so much focused on your own family, your own legacy. Some people have picked other people's families or a sector of society or animals or the environment or something like that. But they found out that if they want to make a really big impact, there's a financial component to it as well. So that's why they started making their real estate acquisitions. So Tim, of those 5 different motivations, what combination of them would you say describes you best?
Oh, good. You gave me combo. I was like, oh, damn, it's gonna be hard to pick one. Honestly, it's I trade my time for money. I don't have any. I'm horrible in regard to balance at this point because of my development projects. I'm leading the way on both. Well, the apartments have now passed my. Okay, back to you. I remember I'm tired. I have ADD number 2. Time for wealth, and also I am building a legacy, and so I want to own my town. It could, because the issue too is that the one that falls in between there is that the description of type A, and I like to be in control so that I can see how I can put it all together. The term they use here in Buda that I love is a carefully curated, and so that's like even with the development, doing a gathering spot. I'm creating a legacy that's going to be there beyond me. It's going to be there for my family to see generational wise, say, hey, my dad did that. And it's, I don't know why, I just want to make cool stuff. I love the goose, and I don't want to get rid of my goose. I'm all about the guy that wants to have the eggs and enjoy it. But time for money, because right now, I've leveraged a lot of things to make these projects happen, so I'm not flush. I'm a dreamer that took my dice and I'm throwing them on the table because it's awesome.
Absolutely, I love that. It takes all kinds, and I don't know, like you heard me before we hit record, that I kind of grit my teeth a little bit. The people who are very like secondary and tertiary as far as the actually getting the work done, the projects,
Yeah.
moving, and so that's why I love to hear that kind of answer. Now, one of the issues of going through motivations is that you run the risk of seeming starry-eyed, even to the point of naivete, just being naive in general. And one of the things that's important to realize is every business has plenty of risks. Real estate is no different. And if you're like me, if you've ever filled out one of the suitability questionnaires to be involved in one of these 506B deals, these private
You
off-market
bet.
deals you're not allowed to discuss, one of the questions bothered me in particular. It was the tolerance for risk assessment question. And the reason why it bothered me is because I felt that it didn't matter which of the 4 or 5 answers you chose, I couldn't really use it. I couldn't really rely on it to understand what that person's perception of risk was. And so that's why for this interview, I made my own one. And it's a fill in the blanks question. It is. There are many popular investment asset classes, but I think blank is too risky. So, Tim, it can be inside real estate, it can be outside real estate. You can give one of each if you want. What's too risky for you to invest in?
Stocks.
Stocks.
I'm a monopoly guy. I believe in stuff I can feel, see, and can control the outcome. There's going to be outside factors, but stocks, I tried it for a while. That's what caused my hair to fall out. I just like, well, what's going on? And someone passes gas across the world, and it can affect your numbers. And I couldn't do it.
Yep. And of course, they all have PR
Yep.
departments, all those publicly traded
Yes.
companies, and their job is to
Yes.
spin whatever's going on to whatever will be more palatable for the public and the investors.
Well, and to finalize that one is, the one thing I had a mentor tell me years ago, and it always sticks true in my head, they're not making any more dirt. And so the value of dirt will continue to exponentially increase.
Absolutely. It's all about scarcity. So that brings me to the favorite deal metrics. This will be right up Tom's alley, but honestly, for the first few hundred chance encounters, I skipped this section because I thought it was a little bit too fastball for some of the people that I might have on as a guest. Specifically, if they're more on the marketing or the PR, front of house, that sort of thing, they're not really going to be spreadsheet junkies. They're not going to be project managers who are constantly on the phone saying, hey, where are we with this? Where are we with that? And getting things done. And so the numbers they probably won't be that comfortable with. But the fact is, you mentioned the curator part of what we do with these different deals here, Tim. And I think that as a curator, even if you are front of house, you're going to have some metrics that you're going to rely on more than others. And so I like to get like a top 3 or something like that. And to jog people's memory, I have this list of 14 different metrics. It's not an exhaustive list. Some people depend on things that aren't really on this list here, but for anybody in the audience who's listening and not watching, I'll read them out for everybody. The first one is cash on cash. Next is IRR, which stands for internal rate of return, which is basically your equity multiple. What kind of multiple are they projecting you're going to have at the end of the investment? There's the cost per door. There's the net operating income. There's the going in cap rate. That is because the cap rates in any given area, they're going to be published by some of the major brokerages. So it's a back of the envelope way to find out what kind of discount you're getting without much mental arithmetic. Then you got the loan interest rate, which is especially important if you're going to be assuming a loan. There's the occupancy rate, which is the inverse of the vacancy rate, so it's the same thing, just inverted. There's the average income where the property is located. There's the amortization period of the loan, which is also especially important if you're going to be assuming a loan, like with seller financing. We've got market versus in-place rents. What's the difference between those, so you can see if there's a little bit of extra margin to be made without much additional effort. There's the population growth where the property is located, so you have some baked in appreciation based on higher demand. There's the sponsorship record, which is how many deals have already gone full cycle, how many are on the go right now. There's the waterfall split or exit strategy, in other words, what happens to your investment after your principal has been returned. Then there's the DSCR, which is debt service coverage ratio, which is how much of the revenue is going out the door immediately just in the form of paying for the loan. Now, Tim, I also get that as a developer, your numbers, your focus is going to be a little bit different. Like, for example, you're the deal sponsor, so you're not going to be really looking into that. But which ones do you tend to rely on?
Really IRR is a huge piece. I mean, and backing up, so I have I've been on the syndication model on the 506B prior with apartments and such, and so just to give that one, I'm right now actually, funny enough, I'm doing a 506C for the first time in my life, just so we can publicly be obnoxious about it. But going back to the things that matter the most for me are IRR. So when we're talking to our investors, what our outlook is, what we're seeing, and making sure to have that that full scale method of, if the great things happen, here's where we expect it. If really bad things happen, here it is. This is where we're putting our model to try to be realistic, but we show everything. And I think that's hugely important. I don't deal in cost per door, except for in my development piece for, like my apartment project where we're looking, and my whole goal on that as a developer is I'm constantly trying to do a value engineer to push that down, but yet still give the right product, because I'm running at $231 is our build out right now. So, some people, when you're buying, you're looking at, you hear about $90 a door, and you're like, heck yeah. But it's having to dig deep and understand exactly what you're getting. And as of, where you being in Ottawa, I know nothing's cheap. Same thing as Austin. And so, we're a different market than some people will be or understanding on how it all works. Going on beyond there, your net operating income, without a doubt, because we're projecting forward. Loan interest is huge because we're doing construction loans throughout. So it's understanding how the model all works, when the draws will occur, and then it goes over to, I'll jump around a little bit. Once again, remember, I'm tired and I have ADD. But your exit pieces is, our ultimate goal is, if we can, we'd like to own it forever, or not ever. Let's say 10 years. That's 10 years. Forever is 10 years in my head right now. But the idea behind it is, if the numbers make sense and we haven't gotten an offer that's completely ridiculous, that we have to walk away and take all the money and just have too much fun, we would like to own it, refinance it, and play it forward. So you can't really project where the market will be, but you have kind of a general idea it's not going to be much different than potentially now. Sponsor record is huge. You're betting on the horse, is the real, or actually you're betting on the jockey, because the jockey, if depending on what their level of experience and knowledge is, they're the ones that are going to be able to jump over those hurdles when they come about, because those hurdles are always out there in the marketplace. I mean, we have the insurance going whack crazy, property taxes going whack crazy. So it's those that are willing to take their sleeves, roll them up, and get down and dirty. Because I have been involved with transactions in the past where, when the bad stuff happened, the sponsor disappeared and this communication stopped. And you're like, what the hell's going on? And, I had an apartment in Houston during COVID. We just owned it, three of us in a tick, tenants in common. And, COVID caused hell. And so it was hell in a handbasket. City was continuing to push us on improvements. It was an old property, 1960. Management was having a heck of a time because of the rules, and so they were letting some people in that shouldn't be in there. We had to just get down and dirty and get in it. And so sponsor record in terms of how they react to bad things, because bad things will happen, is huge. Let's see, going back into market, in-place rents, huge. We did a lot of market studies to figure out where we can fall in our rents, because we know what our costs are. And so we have to be able to say, okay, here's our cost. This is what we're going to build, and so we need these rents to be here. Now, is that actually reasonable? We've been lucky with our project because we're already at 50% pre-leased, and we haven't even broken ground yet, which is unheard of. But I'm in a market with less than 2% vacancy rate, and Austin's less than 5% vacancy rate for retail. Let me see other things to look at. Average income, huge, because I look at all the demographics around our site. Ours happens to be $111,000 per household, but it has to be able to support what you're creating. And if you're buying just an apartment complex, once again, you can get a really great deal in a really crappy area and find out it's really not a great deal. You just bought a piece of crap in a crappy spot. Yeah, Learning lessons, man.
I'm kidding.
But going occupancy falls into what I consider my vacancy for my retail. But occupancy is huge too. Is where's for apartment complexes, what is the trends in that area, and then you have to segment it down to say, in this specific little spot, what's happening, because every little spot is so different than each other. And so, I mean, honestly, cap rates too. And Dan, I don't know. I mean, I read a description of cap rates today that I thought was absolutely amazing. But to me, it's always been that mystery. How is that actually predicted, the going in and going out cap rate? And it just seems like a lot of stuff is made up. I don't know.
Yeah, hopium, the wags, the wild ass guesses. Yeah, that's fun, man. Yeah, I love that. I love that. That's fantastic. I'm
Yeah,
just eating up those answers like a delicious subscribe sandwich. Is that intense enough for you? It's like
dude, I love it. I
I'm
love it.
really fishing here pretty hard, but the next segment here is on the 6 different roles in a commercial real estate deal, and I pull out the Dan Does Deals Commercial Core Competency Cube to do that. If you are watching me go through the 6 different sides and thinking, hey, I really need one of those, well, the good news, it's absolutely free. You go to Dan Does Deals, that's up here, dandoesdeals.com. There's this big conspicuous button you can click on, download the PDF, print it out, show it to your friends and family, and the best part about it is it will help you more effectively communicate on the subject of commercial real estate deals and understand how my guest fits into those, which of course he's done a great job of explaining anyway. But the first role I want to talk about is the repositioner role. That is the most public facing part of the puzzle. They're not necessarily the deal sponsors, but the repositioner, they are asset managers, they are deal curators. One of the things that they have to do is they have to underwrite the deal. They have to find more upside. They need to go through the spreadsheets, find out, first of all, if the property is making the amount of money that the seller/broker is claiming it is, because right? So the repositioner, that's their main job, as the deal finder, the front person, all that kind of stuff. And it's a pretty diverse skill set required in there. And one of the most peculiar parts of being a repositioner is they have to have a vast circle of financiers. Those are people who only deal with the owners, paperwork, and capital. They are not operators. They're not dealing with any residents or tenants or whatever you want to call them, anything like that. And the reason why repositioners need to have a vast financier network, there's a couple. One is it's a very capital intensive business in general, but the bigger thing is that if you can secure a more advantageous loan, aka cheaper money, that's going to go straight to the profitability of the building. So that's why everybody's so eager to meet people who are, physicians, engineers, family offices, things like that, people who can make more deals happen, make more business happen. So that's the second role. But there's the next place where a repositioner is going to be looking to find that upside is they're going to take a look at the operations and say, hey, what's with all these Benjamins going down the toilet? That's no good. But of course, there's more to operations than just unclogging toilets and mowing lawns and collecting rent. Me personally, my history with being a GP is based off of my marketing and tech skills, because after all, I'm from the internet. And one of the reasons why that's important, even on the bigger properties that I tend to pursue, 100 units or more, it's because the vacancy rate really is the deal killer. If you can't get those units filled, even if you are outsourcing to a third-party property manager, somebody on the GP team has to have some serious marketing chops and be able to step in and get those units filled if push comes to shove, and that's where I throw my hat into the ring. But there's only so much extra efficiency you can find in operations because it's a competitive industry. So the next thing a repositioner will frequently do is they'll get a contractor team involved to renovate the place, make it nicer so that the residents or the future residents are more than happy to pay more in rent than the previous ones. But if only things were that simple. Of course, with Tim's background in construction, he's going to be able to say that, just extra expense doesn't mean extra ROI. You can go ahead and gold plate the toilets, but I don't think it's going to help the bottom line at all. And of course, there are some other issues of dealing with contractors in general. And one of the biggest ones, especially if you're like me and from the internet, is you're going to need boots on the ground. You're going to need a local. You're going to need somebody who can be there in an hour or two. And I can tell you that's not going to be me, because I'd be stuck at an airport in an hour or two. So you need somebody who lives nearby.
Or traffic.
Right, exactly. So they can drop in, they can make sure that the contractors are
Yeah.
keeping to schedule, they're not using subpar materials, make make sure that the operations team, they're not sloughing photos, misrepresenting the state of things, and basically check in on the property. But for the sixth and final role on the cube, I like to do a little bit of a hypothetical. So let's say you are a physician or a surgeon or an engineer or an attorney or something like that, and maybe you already have a rental or two or something like that. So you go, hey, I know how this works. I get the down payment, I go to the bank and I borrow the rest. So then you look at an apartment complex down the street that's 350 units, and you get to thinking, hey, I bet you if I turn around to my colleagues and we each pool in like 100K each or something like that, I bet we could take that over. So full of confidence, you turn around to the banks and say, hey, I want to buy that building for tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us, do you? And of course, there's going to be one question the financier is going to ask. And if you are in a coaching program or a mentorship or something like that, I encourage you to listen very carefully to this part because it's very important. The financier is going to ask you, who's the sponsor? Who's the KP? This is the real flaw in that little hypothetical. The fact is, these different lenders, they're in the business of preserving their capital, making sure that they don't lose money. And so one of the fastest ways to make sure that the loans are safe is to only lend if somebody in the fold already owns a similar asset. So there's going to be no 350 unit apartment complex in your future unless somebody in the fold, in other words, one of the GPs, also has a 350 unit apartment complex. On top of that, you need a certain amount of liquidity to show you can run the business, and you need to put up collateral, aka have a balance sheet of at least the amount of the loan. But if you got all those pieces, you got yourself a commercial real estate deal. So Tim, you already mentioned that because you're on the construction side, that de facto makes you a KP sponsor. I understand that you're going to have a few other roles, and everybody has to interact with financiers. But is that the role that you describe that you're taking up in your deals?
Man, I've got multiple hats. Your one that hit the hardest was the local. I actually during COVID for me is I came to the realization, why am I doing anything anywhere else when I live such an incredible market? My rule's ridiculous now. I only invest in things 12 miles from my house. Ridiculous. And but both of my projects are within that window. So I'm a jack of all. I understand all the components of each and every piece of it. But the reality is that's where I lean on my expert team, because I've got someone that's my deep dive financial guy, my guy that I can throw him stuff and he's able to compute and pop it all out. I've actually got even my construction guy that has the deep dive in construction. I know enough to know where it should be and what it should be doing and true expectations. And so, because, every component of it I'm involved with, which is ridiculous, but that's also why I don't have hair, Dan.
It'll do that.
But no, I mean, yeah, and going on the marketing too, I'm on bootstraps for my project that I'm working until we get further down in the component. So yeah, I'm playing a full out marketing game at the same time I'm doing all the other pieces. But but your list, I mean, that was phenomenal. That you just put together a perfect team. So yeah, that's great.
I appreciate it. So let's talk about the buy box then. Tim already mentioned that his buy box is 12 miles away from his place. So that covers the first of the three things that real estate people are asking for when they say, hey, what's an ideal property for you, which is geography. You got to know where it is, which state, which county, possibly which neighborhood. The second one, though, is size. The way that you rate size in apartment buildings is by the number of apartment units. They call it unit count. And a lot of different commercial properties go off of unit count. And the reason why it's relevant this size is because the type of company that's going to take over 10, 15 unit apartment complexes, they're going to be fundamentally different from the ones that are focusing on 150, 350, and so on. So that size matters. Now, of course, there are other forms of commercial real estate that don't go off a unit count, such as retail or warehousing. They go off of square footage and sometimes even acreage, but that size part still matters. Now, the third part is commonly called class. I don't like the term class because it makes it sound like it's only one thing when it's actually two. It's the condition of the property, and it's the area where the property is located. If you're talking about condition, we're talking about how old is it, how beat up is it, how recently renovated the property is, then there are what sort of amenities are there on offer to residents. That's the condition. Whereas if you're talking about the area, the crime rate where the property is located is always going to matter. If you're talking residential, like multifamily, like apartment complexes, the different part is that the school districts where the property is located is going to be highly relevant. But the third part of the area, it's the old trope that brokers say of location, location, location. But in my opinion, what they actually mean is traffic, traffic, traffic. If a gazillion people pass by a property every single day, it's got some baked in desirability, which raises the value just on that merit alone. Now, the way that they rank both the area and the condition of the property is the same system as they use in grade school, where they have A plus at the top, then A minus, then B plus, and so on. So, Tim, as far as your buy box goes, what you're looking for?
So if I was, let's say right now looking at apartments, I would go Class B. I would go anything over 150 units. You nailed it. You know, you talked about the different people in different category. I want property manager on site. I want maintenance on site all the time. I don't want anything below 60. You're really pushing the envelope. Anything under 75 probably is really the envelope where you're just kind of on the line to be able to afford to have those people that are needed. But I would go B, anything over 1985. I bought something older before and I paid a price. I broke some rules and I'll never do that again. My current buy box though is really focused on, well, let me back that up. So my apartment complex is huge. We're right in the middle of an entertainment district. It's in growth. But it's a 5-story wrap, 431 units. And so it's that where, but we know once we build it out, it'll most likely we'll sell that to the investor from Singapore or wherever the heck it might be. So it won't be that long-term hold for this one. My other project, because you talked about square footage, it is acreage. If I were to build an apartment complex, I want to have at least 10 acres. I've got to have all the utilities there. I've got to have all the zoning, 1,000 other list of items, and you'd hit on the head of a lot of them. Demographic, what's around, what is the population growth, what's the drive-by. So I just want everything perfect. That's all. That's all.
Yeah, exactly. And so since we're talking about perfection, let's talk about people. Yikes. Anyway, the 6 different roles here I already listed off, and the fact is we all are eager to be overachievers, do as much as we possibly can. But the fact is everybody's going to focus in on 1 or 2 roles or something like that. And the fact is we are really we all have our own unique skill sets, and that means we're going to be better suited to help some people more than others. Now, the only exception is, of course, everybody is eager to find passive investors, people who are not looking to do the work but are looking to invest the capital. So everybody in real estate is interested in meeting people who fit that description. Me personally, because of my tech background and marketing chops, social media, podcasting, all that kind of fun stuff, I tend to be able to help sponsors and KPs more than anybody else because they've already got that foundation in place. When you're first starting out in real estate, you need grunts who can put in 80 hours a week, and that's simply not where I'm making my biggest contribution. So those are the people who I'm looking for, is the sponsors and KPs and the financiers. And then, of course, in the context of this show, it's if you're in real estate, I want to talk to you. But Tim, as far as people who are out there in the audience, you mentioned you have a 506c deal, which is fantastic because you can actually talk about what you are working on.
It's such a weird new thing.
Right, exactly. Yeah, the B thing. It's just like, hey, what's going on? Nothing.
I know. That's the dilemma. It's like, well, should I just put it everywhere?
Right. Exactly. It's crazy. But yeah, who are you looking for?
For me right now, on your cube. Number one, I am sponsor guy. I am the guy that's gonna play all the pieces of it. What we're looking for, honestly, is if the ideal world. If what I'm looking for is a family office. I would love a family office to get involved because they look at the longer term trajectory. They're looking at preserving because I don't know, Dan. Have you ever been in retail yet? Have you done any? Yeah, because
Oh, retail real estate? No.
yeah, not the apartment. I love apartments. Don't get me wrong, but this whole window of retail is so fascinating. There's triple net leases. I mean, you got those crazy things that are going on with insurance and taxes. You're trying to help your clients and all the tenants, you work it all out. But what it comes down to is the tenants taking the load. Now, for me, I'm actually going to own two restaurants. I point over here because I have a map up of my site that I was looking at before. But we're having two restaurants on site that I'm actually going to own and operate as well. So keep it in mind as the developer. I love it because triple net lease, they're going to take care of all those taxes, those incremental costs, the things that break, all the things that are nightmares that can screw your bottom line as a multifamily operator. But I'm also, because I'll be an operator, I'm paying attention to all those pieces. But yeah, going back to, if for us, we're looking for, if we could find a family office that wants to take a big chunk, or folks that, because we're doing 506C, if they're accredited, we're looking for those people to help us because we already got our project. It's permitted on phase one. We just got approvals phase two. As soon as we hit a certain mark, and our number right now is $2 million, we start pushing dirt, and that's exciting. So yeah, it's and just like any other syndication, we're doing it so that we'll call it the proverbial small guy, with it can go in as low as 50, but they've got to have that accreditation to be able to play forward.
That works, and you don't have to be coy about pointing to your map. As long as you're not saying, "Oh yeah, I got two properties." That'd be a little bit disconcerting. But on this ridiculousness, now everybody in the audience must be thinking, how on earth do I reach out? I'll sandbag that for a second and draw attention to the fact that I've got this enormous last name. It's very distinct. It makes it really easy to find me on social media. LinkedIn is where I spend most of my social media time, so that's the best place to connect, especially if you want to appear on this show. If you want to see more episodes, dandoesdeals.com has the playlist of all of these different episodes. And if you scan the QR code that's right there, that goes to my author page on Amazon.com, where I've got a few different books on different skill building topics and things like that. So you can check that out, buy a book or something like that. But if people want to reach out to you, Tim, I know you're active on LinkedIn as well. What's the best way to reach out?
Yeah, likely LinkedIn because I still have I'm still a broker, so I have my Beyond the Move Realty site, but LinkedIn's the easy way. I also have a website for my retail development called Roundabout in Buda. It's a long one, but every email, every phone call that goes through the system comes right to me. But LinkedIn is the easy.
I love it. I love it. And that brings me to the final part, which is actually not for you, Tim. It is my public service announcement. If you have been watching this episode and experiencing searing pains in your eyeballs, maybe like migraine-like symptoms, I'm confident it's because of the downright hideous subscribe button that's down there that you probably haven't clicked yet. You don't want to.
I was waiting to see where you were going with that, Dan. Go ahead.
Right, exactly. And that's the thing. It's like if you got kids in the house, they're very judgmental. They'll see that you haven't subscribed yet, and they'll be like, I thought I knew you. And I should tell you, full disclosure, the reason why I want people to hit the subscribe button, it's so those deadbeats at YouTube start paying for these videos instead of me. I think that would be amazing. And the trade-off to you is that sometimes my videos may show up on your list of suggestions. You can go ahead and ignore those suggestions because, quite frankly, I just appreciate the fact that you spent this time with me. Just like Tim, I appreciate you joining me. This has been awesome.
Dan, I tell you what, I'm impressed by you, man. I've watched you on LinkedIn for years, and this is our first time to get a chance to talk. But I'm impressed. You know your game.
Thanks, man. All right, have a good one. Hey there, are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.